record. Okay, perfect. So before we start, I'm going to pass it over to Ajit Raj to introduce our guest.
Thank you, Arlene. Good evening, good afternoon, and good morning to everyone. It is indeed a pleasure to introduce to you Kate Marshall. Kate is a sustainable investing specialist at Morgan Stanley Investment Management. In her role in the sustainability team at MSIM, Kate coordinates and executes various initiatives, including projects related to ESG data, portfolio analytics, and client reporting. Kate also contributes to the development of MSIM's ESG investment integration standards and drives research and development of conceptual frameworks to support the launch of thematic sustainable funds. Prior to MSIM, Kate worked at Business for Social Responsibility, where she primarily advised private equity firms on ESG integration, due diligence, and impact investing. Kate has also been the lead ESG analyst for the materials sector at Sustainalytics, where in addition to conducting company and sector level research, she advised clients on ESG integration, supported shareholder engagements, and contributed to the firm's methodology innovation. Kate holds a master's in public policy from the University of Toronto and a bachelor's of arts in international relations from the University of British Columbia. Welcome, Kate. Back to you, Arlene.
Thanks, Ajit Raj. Awesome. So let's dive right in. So again, thank you so much for being with us, Kate. Maybe you can start off just by talking a bit about how you found the impact space. Was it something that you were always interested in? And how did you kind of get to where you are today with Morgan Stanley?
Yeah, sure. Hi, everyone. And thanks so much for having me and for tuning in and being interested while you're trying to get all of your end of year deliverables out. And yeah, thanks so much for the invitation. So how I got into this space was a little bit roundabout, but also sort of a common path from a number of colleagues in the industry, which is I started off in this sort of international development space, more so working with nonprofits. And doing that work, I started to become very interested in the limitations of that work and what I saw as some stronger opportunities on the private side to have impact. I was working in Latin America for a little bit with some nonprofits, and particularly was struck by the impact of the mining sector, in particular the Canadian mining sector or Canadian mining companies in Latin America. And so I started to kind of get really interested in that space. And really, actually, after my master's of public policy, ended up cold calling some mining companies saying, you know, hey, I think I could be helpful to you in these ways because I offer this different skill set, experience working in Latin America. I speak Spanish. What do you think? And I didn't hear back from a lot, but I heard back from one, and they were like, yeah, actually, we have someone who's going on maternity leave for a year who does a sort of split corporate social responsibility communications role. Are you up for that? And I said, sure. And so that was my real sort of entry point into post-grad work. And that role was great, but pretty quickly I saw that who the company was listening to was their investors. It wasn't just like bright-eyed, bushy-tailed, fresh employees that they had. It was really their investors that they were paying most attention to in terms of why they would make certain business decisions that could be beneficial to the environment or communities. And so through that, I started to learn about this whole world of responsible investing, and was sort of led to Sustainalytics, which is co-headquartered in Toronto and also in Amsterdam. And a number of Schulich grads work there. I guess maybe you're familiar with Sustainalytics already, but that really provided me with a strong foundation in the responsible investment space. And the opportunity to interface with investors on the topic. And then for personal reasons, I ended up moving to New York and switching to more of a consulting capacity because I found, you know, being a sort of research analyst, it was very similar working at Sustainalytics to like sell side research. You have this like portfolio of companies that you're responsible for. You have to update those anytime new information comes out about those companies from a sustainability perspective. But sort of once you get that flow and a mastery of your companies, for me, it felt that that was either I'm going to go deeper in mining and become a subject matter expert there, or I need to do something else and sort of broaden my skill set. And so that's why I was drawn to a consulting role where I was working with the buy side more so. I mean, it was private equity, but working more so with asset managers on how they integrate that information, that sustainability information into their investment decisions. And then through that work, was connected with Morgan Stanley, and there was an opportunity to sort of then be in-house. So after being in a research role and a consultancy role, obviously the next place that was interesting to me was to be sort of closer to where those investment decisions are made. And so that's what sort of drew me to the role at Morgan Stanley. But I'll stop there because I think we'll spend more time on the Morgan Stanley piece where I am now, but that's sort of the trajectory. So it was I didn't even know what responsible investment was when I finished my master's of public policy. It really was a discovery. And I certainly didn't know what it was when I finished my undergrad.
Amazing. So yeah, maybe we can kind of touch on some of your work at Morgan Stanley now. So, when we talk about ESG investing, how does your company approach it? And
Yeah.
Was it something that they've always kind of had a focus on, or is it something new and they're trying to change with the times? And is it something that's just a very small portion of what the company does, or is it something that's truly embedded into the company strategy as well moving forward?
Yeah, that's a great question. So Morgan Stanley is made up of the investment bank, investment management, where I sit, the asset management arm, and wealth management. And across these three units, there is a function called the Global Sustainable Finance Team that's existed for over a decade. And associated with it is something called the Institute for Sustainable Investing. And that's something that James Gorman, the CEO of Morgan Stanley, sits on the board of, and launched as part of the firm's commitment, and as a way to sort of really frankly just a top-down way to embed sustainability across all of the firm's business units. Now it's a massive firm, with 50,000 employees. So we have that one team that sits across, but then within all the business units, wealth management, the investment bank, and where I sit, there's all these other sort of sub-sustainability or sustainable investing teams, like the one that I sit on. So that's sort of the first part of the question. Yes, it's very embedded. I would say each part of the business does it in a different way and is sort of at different phases of its journey, so to speak. Like our wealth management business has had a very established impact investing practice for actually almost a decade as well. And these are where our retail investors are. So high net worth retail investors who are demanding to see, sort of positive impact associated with their investments. Where I sit in the institutional investor space, so the clients in the asset management arm are pension funds, endowments, university endowments, foundations. The demand is growing, and it's growing exponentially because the beneficiaries of these pension funds and endowments are sort of demanding this. And so it's becoming a huge part of our business. And sort of the latest figure we have is that 80% of our assets under management, so the assets that we manage for our clients, are managed according to some sustainable investing approach. And so just to give more context of what that means, there's sort of a gradient that we consider. It's step one is are you considering ESG factors at all in your investment process? Do you consider these non-financial criteria at all? And we call that ESG integration if you're doing that. And that is something that we're increasingly expecting to be a baseline for our funds. There's numerous studies showing that these factors are financially material, numerous studies showing and refuting the argument that considering ESG means lower returns. That has been disproven. And if anything, they help reduce downside risk if you integrating ESG factors. And so we've sort of in our division said like this should be table stakes and a baseline requirement. And a lot of our clients won't even talk to us if that isn't the case. And building on that is where it gets a little more interesting. Building on that is the exclusionary approach. So it's like, okay, you're considering ESG factors. Are you also like excluding sectors that are from your investment portfolio that are seen sort of sensitive or high risk from an ESG perspective? And these are like fossil fuels, tobacco, alcohol, whatever. And we don't see that as a requirement to like be a superior ESG fund. It's just kind of like a next level. And some of our clients demand that of us. Then the third level where we're starting to see a lot of new fund launches in our division is something that we're calling like sustainable core funds or just sustainable funds. But these are funds where it's not only are you considering ESG, but ESG factors are a binding part of the portfolio construction process. So it's like very easy to sort of say when you're building a portfolio, it's like, yeah, we looked at the carbon emissions and we looked at their sustainability reports. And like, we're kind of loosely aware of all the risks, but we sort of ended up going with our original investment thesis anyway. Sustainability funds and core funds are speaking to this idea of at the outset, you set, these are my binding sustainability criteria that I want to have included in this fund. And so I want a carbon emissions intensity no higher than X. I want a certain amount of revenues dedicated to what I deem sustainable activities. And we'll get into data sets that can help with that later. Or it's, I want funds, only funds that have a net zero emissions target. And like, so for us, sustainability funds are funds that have like binding intrinsic criteria that dictates the portfolio construction process. Or some of our teams use ESG scores. They have their own proprietary ESG scores. And they say, you know, everyone needs to be in this quartile to make it into this fund. The final sort of frontier is this idea of impact. So it's like, not only do you have these like criteria that you're using to make investment decisions and construct portfolios, but you're also then trying to measure like, what's the outcome and the impact of those investment decisions? Like, did I lead to more jobs created, carbon emissions avoided, et cetera, water saved? And that's really like kind of what we see as like the pointiest end of the spectrum. And admittedly, where we have the fewest funds. Part of that is hesitancy our teams have around data availability and measurability, because we just feel like if you're going to have an impact fund, you need to be able to measure that impact. And there's limited tools to do that, particularly in a public equity space. But we have the funds we do have are in the private equity side. So I hope that answers sort of how we think about it and the level of embeddedness.
No, definitely. Thank you. So maybe we can kind of jump into what sectors specifically, you know, Morgan Stanley focuses on when it comes to investment opportunities. And I guess the second sort of facet to that question would be when you do look at those kind of ESG standards and metrics, what are you measuring and how good are they, and where are they not so good?
Yeah. So from a sector standpoint, I mean, I sort of have two answers. Like, one is that we're invested across all sectors. That said, we actually are naturally quite underweight energy, which has been helpful to us for from a climate perspective. It's not, I wish I could say it's like some intentional choice, but it's just a result of the preferences of our portfolio managers and their investing styles. We tend to be much more overweight healthcare, tech, basically, and some consumer discretionary. And so that in some ways makes it like, and I've sort of, in some ways that makes our current situation, like we have a sort of easier starting point, because right now the main focus, you know, across the board is climate change. But as we think about climate change, it's not just limited to fossil fuel companies. I mean, that's where the bulk of the research is. But we are all going to have to figure out our alignment with a net zero pathway by 2050. And in some ways, we're finding that quite challenging for our sectors because there's just actually less written about it and less sort of scientific agreement on what are the agreed upon pathways for these sectors that are not super fossil fuel intensive. And so that's sort of one comment on our sectors. Like, we do hold oil companies here and there, but like our top 200, so we own, just thinking of the equity side, like we own 6,000 different equity names, but 80% of our equity AUM is concentrated in the top like 200 names, because most of our teams are quite, are run active, concentrated portfolios. We don't do any passive investing. We don't have ETFs. And so we tend to hold very concentrated portfolios. And that sort of has led to some of this underweight energy. The other way I was going to answer the sector question was from an asset class approach, which I know isn't quite what you were asking, but I think it's interesting. Just a quick comment there is that most of our assets are in our equity business, but we also have fixed income, liquidity, private credit and equity, and real assets, which includes real estate and infrastructure. And then we have a sort of multi-asset business, which includes multi-asset portfolios and alternatives and fund-of-fund portfolios. Like, we have a hedge fund of fund business. And I think, you know, we don't need to like sort of get into it all now, but like it is interesting and worth sort of looking. The Principles for Responsible Investment has a lot on this, at the way ESG is different in all those different asset classes. Like, equities is obviously the most trodden, and there's the most sort of tools and resources there for investors, and the most data, to your point on data. On the private market side, like, these are companies that are not publicly traded. They're not required to issue like sustainability reports or annual reports. And so all that data has to come from the investors themselves. You have to go and get it and collect their carbon emissions and collect their water usage. There's not a Sustainalytics or Bloomberg collecting that information for you like there is on the equity side. So if there's questions on the different asset class sort of variances, I can get into that, but just wanted to highlight the sort of ways in which ESG is advancing differently across asset classes.
That's super helpful.
I didn't answer your data question, but I can answer that too.
Yes, please.
So even though I came from the data side, Sustainalytics, it's very interesting now being on the side of like using that data, because it's really not as great as I thought it was, or it's just like, it's not so clear cut. And what's also interesting being where I sit now is we don't just subscribe to Sustainalytics. We have Sustainalytics, we have MSCI, we have Bloomberg, there's new ones popping up every day, ISS, S&P True Cost, like there's dozens and dozens. And I think that's both a pro and a con of the space right now, because our clients all use different data points. And so they want to see data provided by these different vendors. And there's also, because it's such an emergent space, there's not a lot of agreement among these data providers. We see a lot of agreement in things that are reported by companies like carbon emissions. Like, that's not going to be such a different data point depending on the vendor you go to. But once you move away from those sort of raw company reported metrics and get into like all these different providers have scores, like a low carbon transition risk score, you know, what are some other scores, like a human capital management score, like all those scores are based on estimated risk exposures, subjective management quality scores that all these different providers come up with. And the correlation among them is null. And we find as active investors that the usefulness of them is limited. I think for portfolios where it's a sort of passive strategy, these types of scores tend to work better in terms of constructing some sort of index, some sort of ESG index. But our teams tend to gravitate towards any sort of actual raw data points. So carbon is a big one for us because we just feel like it's one of the most strong and concrete data points. The other data that we're starting to explore more is sort of on the impact side, is we're seeing a lot of data providers come up with like sustainable impact data, which is all based on revenues. So it's like taking of the revenue breakdowns of a company and trying to see if any portion of that revenue can be aligned with some activity that helps to fulfill the UN Sustainable Development Goals, for example. And we're starting to use some of that revenue data because we feel like it's a good proxy for sort of intentionality of like what a company is trying to achieve. And it's particularly interesting to obviously see if those revenue portions grow over time. But again, there's variance, like the way MSCI defines sustainable revenues and what they'll include in their revenue count is different from Sustainalytics and whatnot. So we spend a lot of time trying to sort of cut through that noise and focus on the raw data that's not sort of score based.
Mm-hmm. That's a really good segue into the next question that's sort of about due diligencing these companies and funds. You know, what are some of the important things when it does come to ESG and due diligence, and how, this is a hard question, but how do you make sure that, you know, a company isn't just greenwashing and that, you know, this is legitimate commitment on their end? Yeah, so I know it's a hard question, but I'd love to.
Yeah, it is, but it's the like, you know, $1 million question. I think we do a lot of sort of bottom up research, and our investment teams tend to be sort of have long-term positions in these companies and sort of a recognition that change does take time. And so we find that monitoring companies' progress over time can be a helpful way to sort of gauge commitment. And then, you know, even though I just sort of didn't speak so highly of all the data providers, like our teams do proprietary research, their own desktop research, and then use those third-party data providers to sort of validate their findings. I think the biggest way that we try to get to know companies, though, is through engagement. And this is in the equities and fixed income side, is as active owners, we engage directly with our companies. So our portfolio teams and our dedicated central stewardship team speak regularly with all of our portfolio companies, or sort of our most concentrated positions, let's say. And these conversations happen minimum once a year, but often quarterly, and sort of basically track a company's commitment to what it's saying in its sustainability report. Any like negative news events that we see in the news about them, you know, we call them up and say, you know, what happened here? Like we sort of, and we don't like what, and often we are giving our suggestions as well and sort of gauging management's receptiveness to those suggestions, which is another sort of way we gauge commitment. And of course, like a one bad conversation with a company isn't going to result in, oh, we're going to exit that position now. But it is like a trend line, and these are like documented conversations that we're having, and we measure in each of those conversations sort of like, did we ask the company to do something? Did we express a concern to the company? And those are flagged in a system for us so that next time we go and talk to the company, it's last time we asked the company to disclose its scope 3 emissions. Have they done it yet? No, they haven't. And that comes up again and again. Then we might consider an escalation strategy, which before exiting a position, it might be writing a letter to the board. It might be voting against management at a shareholder meeting. We could, if there's not a relevant shareholder proposal on the proxy ballot, we might just decide to vote against the head of like one of the relevant board committees. You know, one of the things that we've been pushing is board diversity. And for companies that don't have any women on the boards, we've been voting against the head of the nomination committee, for example. And so voting is a way in the equity space that we can escalate our sort of views to management. And then of course, like we can always exit or like size down our position. But those are sort of some of the tools we have in our toolkit when we feel like a company's commitment to sustainability isn't where it needs to be.
Great. And I guess when we think about, social purpose finance and impact investing as an industry, it's still relatively newer than, VC, for example. But I'd love to hear your thoughts on, where you think where that trend is going with this space, and especially, looking, a few quarters from now because of COVID.
Yeah.
What do you think lies ahead for this space in this sector?
Yeah, I don't, apologies, have numbers at my fingertips on the growth of impact investing in particular, but maybe Aline, I'll send you some numbers. But like for just general sustainable investing, the US Sustainable Investing Forum puts out a report every 2 years on the growth in numbers in sustainable investing. And I think we're now at 1 in every 4, 1 in every $3 is invested according to some sustainable investing approach. So I think we're seeing the growth become pretty huge, but that's why I think it's important to start differentiating between the types of impact of ESG investing, and to really pull out like what is true impact investing and what is just the sort of ESG investing. And those numbers do exist, and I will try to look and share later. But regardless, we're seeing the growth a lot on our end, and I think where we're really seeing the growth is in Europe, and that's partly regulatory driven. The European Commission last year announced something called the Sustainable Finance Action Plan, which had 10 sort of legislative acts touching on all different parts of the financial system. And one of them was particularly interesting from an impact perspective. It's called the EU taxonomy and the Sustainable Finance Taxonomy. And basically it identifies 6 impact sort of categories for investment that are like climate adaptation, climate mitigation, communities and human rights, natural resources and biodiversity. And then for each of those categories, it defines a number of activities that sort of qualify, in their view, as a true impact investment or activity. And so this list is publicly available and hyper detailed. But basically, this is a regulator saying, we want to cut through the greenwashing and everyone calling their funds sustainable and impact and this and that, and require investors that if they want to label something an impact fund, they actually have to state the extent to which it's aligned with these specific investments that we think truly are going to contribute to climate change mitigation and adaptation and prevent biodiversity loss and whatnot. And so that's something that's coming into force in 2022, and that like the industry is like terrified about and also just bracing for, because we don't have a choice. But I welcome it, and I think it's going to really bring some clarity to what it means to make an impact investment. And it's going to direct, the ultimate goal of it is obviously the European Commission is freaked out that, we've been doing ESG investing for all these years, but carbon emissions keep going up. So like, how do we actually get investors to direct capital to activities that make a difference, not just companies that, aren't causing harm, but like companies that are actually making a difference. And so they've come up with this list of activities as a way to get investors to do that. So I think in Europe, we're really being pushed by regulators. And in the US, the demand on the impact side still is mostly with like retail and high net worth. Morgan Stanley came out with this tool last year in our wealth management arm called Morgan Stanley IQ, which is for a retail investor to basically, it's like a portfolio X-ray tool that allows you to sort of look at your investments against a set of values. So basically, if you're a client, you do an intake assessment of like a huge long laundry list of sustainability and impact topics that you care about, quite detailed, but like climate change, ethnic diversity, like human rights, like I'm being very high level, they're more detailed than that, but like those types of things. And then you, after you get that intake summary, they then sort of do an overlay of those values against your portfolio using third-party data. So again, it's like you're taking a vendor's view of those companies, but it basically tells you like, hey, Kate, like you say you care about human rights. Well, you're actually invested in these companies that have found to be violating human rights in their supply chains. And it gives you as an opportunity to talk to your financial advisor and say, well, actually, I don't like this. And I didn't know I was invested in these companies, like, and have that conversation. We've seen huge growth on that tool as well, and lots of interest. So in the US, I think impact investing is still more retail and still more like, to, sound cliche, because I know there's like a million articles on it, but like millennials and women.
Mhm.
Yeah.
Great. So I know there's a lot of people in the call that are hoping to pursue impact investing, are super interested in this space. So just before we open the floor to questions, I just had one last sort of note. What would you kind of say to anybody that wants to pursue that path in ESG and sustainable finance? If you had any tips or advice, I'm sure they would really appreciate it.
Yeah. Well, the first thing I'll say is that this industry is evolving like every day. There's a million new like frameworks, initiatives, research that it's very hard to keep up with. And so the benefit that anyone has is that it's very hard to become expert in this space. And so jumping in at any moment and simply reading the industry news on this is a leg up. It's also not rocket science. Like it really is just like reading and understanding all the different regulations, all the stakeholders, the alphabet soup of things like SASB, TCFD, UNPRI, SDGs, like understanding all those things and how they work together. That's like really half the battle. And so one piece of advice is like, don't be intimidated. Like a lot of this can really be read. Of course, like as the industry matures, places are looking for people who have like some experience in ESG because it has been around a little longer now, but like a lot of it is really able to be sort of self-taught or caught up on. And then the other advice I'd give is there's also like some interesting either low cost or like free accreditations out there. The Principles for Responsible Investment has a sort of introduction course. I think SASB has some courses, not here, but so not relevant, but just maybe it'll be here soon. The CFA in the UK has a sustainable investing accreditation you can get. And so we might start to see something like that here soon. So some of that self-learning I recommend, and then also like what you're doing, networking and learning about the space. And then I guess being just like open-minded to the different opportunities, like as the industry matures, a lot of different types of roles are coming out. Like you can be a ESG data specialist, like someone who knows how to do like Python and also has an understanding of sustainability, and they can help us build investment dashboards. Or if you're really like have like a sort of legal regulatory brain, there's a need to have people who can help firms navigate all the sustainability regulation that's coming through from various jurisdictions. Marketing, huge need for proper sustainability marketing and people who can sort of like understand the like communication side of things, but truly understand the sustainability content. So, think about like all the different aspects of it, because it really has become a sort of integrated discipline across companies. And so there's a lot of different ways to sort of get into the space.
Amazing. Well, thank you. I think we're going to open the floor to questions. If anybody, you want to raise your hand, as Matt said, feel free. You can also type in the chat. I did get a question earlier, so hopefully I'm able to ask it correctly, but feel free to jump in. So the question is, does Morgan Stanley measure cost exposure or the location of the assets as indicators of their sustainability, similar to the exposure through revenue? So sort of like supply chain strategy.
Oh, supply chain. I'm not, well, so I'll answer one way, and then maybe if I don't answer the way that the question was intended. One thing that we're starting to look at is physical climate risk and the sort of impact of things like severe rainfall, heat waves, cold waves, wildfires on our real assets and infrastructure assets, and to some extent starting to look at that in the sort of operational footprint of the equities companies we're invested in. But that's one way that we're looking at asset location. But can you maybe clarify if that wasn't what the question was getting at?
Hi, Kate. Sorry, I'm instigated that question. Eileen
Okay.
did a good job with it, but it was a bit out of left field. I'm the new director of the new Weston George Weston Center for Sustainable Supply Chains,
Oh,
and
great.
one of the interesting things is we're very interested in how people take action on sustainable, social, and environmental sustainability. And of course, it's tied in with the financial sustainability of companies
Yeah.
and their actions. And this is exactly it, as you eloquently put it. The problem is there's many ways to measure exposure and therefore how risky an investment it is, and how good an investment is in terms of the positive of what good it can do, whether it's a green business or whatever. The one thing that I see as a challenge is how would I use something like the taxonomy for sustainable activities, the EU one that's just came out for ratification like June, I think, isn't it?
Mm-hmm.
June this year. How might we use this to motivate all those companies that are not only private but public, to motivate their managers who are in the operations side that make decisions, capital budgeting decisions, that use the investment capital that's the investors bring into it, but how to get them thinking about, you should factor something in other than the ROI, right? And that's kind of the problem I see a little bit with this, the ESG area, as I can see why investors, retail and institutional investors are putting pressure on companies, because their clients are telling them to do so. But the other side of the coin is these investors can see the risk that is in the operations of some of these companies. And you mentioned climate change being a risk to a supply chain company because, if the weather gets volatile, suddenly their on-time delivery suffers. They might start losing assets, that sort of thing. Whether they will make a decision about what kind of truck they use, other than whether that truck is more dependable, where they might pick a truck, for instance, that uses a hydrogen fuel cell or some form of hybrid engine is another thing altogether, right? So we're trying to figure out how to get traction on this idea of whoever's supplying the capital to companies looks at also the profile of the company's operations, its risks and its opportunities to improve itself that also have spillover effects onto the environment. And I'm a health and safety researcher, so obviously also keeps their employees, their customers, and their suppliers safe. No more Rana Plaza.
Yeah. Yeah. Well, I mean, yeah, Rana Plaza was a huge inflection point for the industry, and I think is still used as a business case for why this stuff really matters. I mean, to answer your question, like the way we handle it at Morgan Stanley is through engagement and through the investment decisions we make. And I think the point of the EU taxonomy and why it's going to incentivize is it's supposed to try and move capital flows to companies that are addressing sustainability. And so if like the whole idea is like, if you get investors to care about directing capital to these types of activities, then companies are going to care, and companies are also going to get better at disclosing what it is they're actually doing. Like part of the problem with the taxonomy and its implementation is that a lot of the data it's asking for is very detailed, and a lot of it, like based on disclosures today, as they exist, like 5% of the MSCI ACWI, for example, is aligned with the EU taxonomy. And we need companies to start transitioning their activities and also to start disclosing it. But the biggest tools in our toolkit are really engagement and talking to companies. And our investors, take a materiality-based approach and are aware of the impacts that supply chain disruptions can have on their business, and also the reputational risks, and take those seriously. And back to the escalation examples I was using, this year we voted against a shareholder resolution at a major consumer goods company that had a shareholder resolution filed about deforestation in its palm oil supply chain and in its paper goods supply chain, actually in the Canadian boreal forest. And that's a company we have a huge position in, have held for a really long time, and that our team, we know the management team. So to vote against management on something like that is serious. And so, it's not always a magic bullet, engagement, but that is the tool we have, and also why our investors often tend to take a sort of holistic sustainability integration approach versus divestment.
I noticed just from your example, you didn't come up through the normal financial market side of things. So
No.
you seem to have some insight into these things. Is your level of insight into the activities of these companies when you have these engagements, is it shared with your colleagues such that they're able to, when they have the engagement, to know what questions to ask about the operations to figure out, is there going to be any potential for conformance to these activities, these sustainability activities? Or is this something, and I'm thinking of the other people on the call here, do they need to educate themselves in things other than just finance to get to this?
Yeah, I mean, I think it sounds like people on the call are educating themselves on both. And I would recommend that. And I think, a lot of the investors I partner with are folks who have, are CFAs and have been portfolio managers for years, but have a true either passion for sustainability or have a true belief in the sort of materiality and business risks and opportunities it can pose. And so they've taken it upon themselves to learn the right questions to ask. But often there's sort of people wearing both hats at most of firms these days. And I think that partnership is really what makes sustainability programs strong. Because at the end of the day, sustainability is like a sort of new and integrated discipline, that requires collaboration from different types of sort of thinkers and skill sets. And so, I think both is the answer, but I also think it's okay if you're a little uneven. Like I'm uneven on the financial side, and I'm doing okay.
Thank you, Kate. Appreciate it.
Great. So we have a few more minutes. Matt, maybe if you had any questions or if anybody else wants to jump in, feel free.
Sure. I'll throw a question out, and again, people raise your hand, and I can direct the conversation over to you if you have a question. I just want to go back to kind of the start of your talk. You mentioned the limitations on the nonprofit side, and my assumption is that those limitations are on account of a sensibility of sector, and that there's just more impact to be had on the for-profit side, and that you're feeling those limitations was out of an interest to find a more impactful space.
Yeah, it's what impacted with me, right? I mean, I think now that I've been on this side for a while, I also see the limitations here, and also the role that the nonprofit sector does play. Like a lot of the shareholder resolutions we review and a lot of the corporate campaigns that cause headaches for our companies and reputational risks for us are caused by nonprofit or NGO activist organizations, and they play a very, very important role in getting issues on our radar. Like there's a couple NGOs that we get briefed on by quarterly or a couple times a year, particularly around proxy season, to tell us like, you know, the background of certain shareholder proposals and what they think the risks are of a certain company. And we really value their input. So I think, you know, that was the view and the path I took at the time, because I think I did feel frustrated, like just, you know, with the limitations in terms of like resources and scale. But now from where I sit, I see actually that it's, you know, again, sort of this both answer. Like, I think nonprofits also play a really important role in the sustainability space, where they are the ones to raise issues and they can say stuff that we can't, right? Like we, as investors, you know, aren't going to go do some like smear campaign on our own company, but we're going to talk to that company one-on-one if we think something is up. But they really get the conversation going, and I think that that can still be hugely impactful. So
Yeah, maybe just a follow up in spirit, but not necessarily in content. When you mentioned like there's certain things that they can say, I'm curious about when you were talking about your journey to your current post. I'm curious how you find the difference between working in an external consulting role or consulting and research role, and then working in-house on these initiatives, because I do imagine you're essentially speaking a different sustainability language in that shift.
Yeah, no, that's a great question. I mean, I reflect on that one often because Sustainalytics and BSR are dedicated sustainability firms, right? So I was one of many people. Like that's what everyone who worked there was focused on. Where I am now, you know, it is embedded in what we do, but there's not like not everyone is dedicated 100% of their role to sustainability in the way that I am. And that's made for a lot more interesting conversations. It also like for sure can be frustrating. I mean, things like don't move as fast as you want them to. And often what the real push is because our clients want it, or because there's regulation coming down the pipeline, or risks that can no longer be ignored on the climate side. And so, you know, when you're a consultant and on the external side, it's like very easy to research and give advice. And then when you go in-house and actually have to implement it and like change operations and change ways of doing business, it's very challenging. And it can be both, you know, it's frustrating on both sides. It's frustrating because I want things to move faster sometimes. It's also frustrating because I'm getting advice from consultants and I'm getting advice from NGOs. And I'm like, listen, I agree with you, but there's a million things we have to do to get to that point. So that's probably the biggest difference, is just that sort of like mental shift.
Yeah. Curious also, this sparked something else for me when you were talking about I believe it was sustainable core funds.
Yeah.
What would be the difference in due diligence between this and say like the proprietary measures that you mentioned that other folks are working with? Because I may be very wrong about this, but it seems like the system you have in place, though likely more accurate in the processes that you use, and more accurate than like separating companies into quartiles, essentially.
Mm-hmm.
That would demand a much more accurate research practice and a much more intensive research practices to reach those stipulations, basically.
Yeah, no, you're right. So I don't know if I quite understand the question, but like our sustainable core funds use like binding research criteria that our investment teams decide themselves, and it varies. And it varies team by team in that some teams, they are using proprietary scores where they get like a third party score that they think they need to reweight because they don't quite like the way the vendor created it. So they reweight the score and add in some other inputs, create their own model that scores every company in their investment universe. And then from there, they sort of have like the top performers, and then maybe go through and do a sort of like manual review type thing. On the equities side, it's usually less sort of top down and score based for the way our teams function. And it ends up being more, okay, like we have our investment thesis and the type of companies we want to invest in, but we also have this sustainability thesis, and that we don't want companies that breach certain sustainability thresholds or criteria. They're typically around carbon emissions, or some are positive inclusion. It's not just like, oh, we don't want these companies. Some are positive inclusion criteria around the sustainable revenues piece, for example. So I think it varies between our teams. Some teams have like very simplistic models, and some are using like sort of models that scoring models that take into account third-party data, and some it's like in-house generated data.
Yeah, thanks. I did ask it in a very terrible way, so thank you for understanding what I said and answering.
No.
Not to go back to the EU taxonomy, but I think it's one of the most interesting things that I'm taking away from this. I'm curious what your sense of how, first I should clarify, I'm understanding correctly that the European Commission governs over this and it's only applicable to Europe right now?
Funds marketed in Europe. So for a global manager like us, we will be subject to it.
Yeah. Is your sense that, say, a similar regulator in the United States could implement something similar? Like, could being the key word, like, obviously all of this is context dependent and it takes someone that's willing to move a mountain.
Right. Yeah, I mean, it could. I think the pace of, like, I think what we're seeing actually is a lot of countries adopting their own. So Canada has actually started to develop their own taxonomy that's mostly based on the EU one, except makes some allowances for oil and gas. Surprise, surprise. Some other countries are starting to like take the EU one and model on that. We're hopeful that that's what will happen. The EU one is like extremely detailed and not perfect, but like the level of expertise and technical committees and working groups that have vetted this thing from across the industry, it makes it quite strong. And I think it would be very challenging for the industry if like different jurisdictions came up with these taxonomies, because managers just don't operate in that way. We don't really think about our funds, our investment strategies by like Europe and the US. On the US piece, oh man, like we're seeing the US under this administration move in like a totally other direction, but everyone is hopeful that under Biden, some of that will be reversed. Biden's already started to talk about making climate and ethnic and gender diversity disclosures mandatory for companies that are listed. So they would have to be disclosing that information to the SEC, which would be huge and also very helpful for investors, because then we're getting quality data, not this data that's like estimated by a third-party vendor. So I think the US might like catch up is strong, but might like sort of start to follow. But we are starting to see other countries think about the taxonomy and how to implement it and like adjust it. But I think our voice in the industry would, or preference would be that we all follow the European one.
That's great. Thank you very much. I think with that, being that we're approaching 7 p.m. Toronto time, we'll bring the Q&A portion to an end. So on behalf of Net Impact Schulich, I just want to reiterate our thanks to Kate. Thank you so much for taking time to participate, to share, and also being amenable to meeting over Zoom. I know it's strange. So thank you, and to all of our Zooming attendees, thank you everyone, and enjoy the rest of your day or evening, wherever you may be.
Thank you so much for inviting me and for listening.
Thank
you.